Good afternoon, everyone. We are going to get started here in just a few minutes. We'll let a few of the people here enter through the doors. You are tuning in person, and I stress the in-person part because for many of us, myself included, this is probably one of the first in-person events in way too long of a time. So I'm super excited personally to be here. I'm at NYU Courant in New York City normally, so coming here and visiting beautiful Lausanne on such a beautiful day is a real treat. You are tuning in to the session called Advances in Machine Learning Approaches for Financial Decision Making and Time Series Analysis. This track I'm co-organizing together with Nino, who is to my right here, and Viva, who's also sitting in the audience. So I want to thank my co-organizers. I want to thank the organizers of this wonderful event. I attended it in 2019 and had a really great time. So again, very nice to be back. And we also have a few sponsors as well. Our home institutions, ISOT, a fintech startup. If you're not familiar with them, check them out on the web. And also So Big Data. So what is this session going to be about? Well, as you saw, we're going to talk about financial decision making and time series analysis in the context of financial applications. So we're going to be mixing and matching a little bit the theoretical aspects of this field with the more practical aspects, hopefully give something to everyone who is attending here today, because I think we have a nice mixed audience. Maybe with a raise of hand, how many of you are academics? Okay. And how many of you are industry practitioners? Okay, so it's about 50-50. I counted real quick, so it was like 52-48%, so roughly. So let's talk a little bit about the common problems and tasks in finance. We encounter a broad set of decision-making and time series tasks, and this is just a subset of what we see. One can group them in a number of different ways, but one way of thinking about it is applications in investment management and trading, very close to the financial markets, leveraging financial market information, data feeds, so on and so forth. So this might include forecasting the markets, performing portfolio construction, doing hedging of traders' books, optimally plan and execute trades, of course, managing and measuring risk. But there are many other assets or many other aspects to finance, such as that of retail and corporate banking. This is critical for many businesses to have access to credit, corporate loans, providing payment systems, fraud detection, right? Think credit card fraud, but also shopping behavior, recommender systems. What should we recommend? What kinds of products should we recommend to our customers? And also, of course, insurance and tax planning, two topics that we're not really going to address during the session here today. In fact, the topics that we have pulled together with the fantastic speaker lineup and the panelists are representing these types of areas, right? Forecasting of financial markets, sentiment analysis, market making, we'll hear about trade execution, risk management, fraud detection, and shopping behavior. So we hope that we're going to have a really nice afternoon here together. We have a couple of breaks in between. We strongly encourage you to fetch down not just the organizers, but also the speakers. Take an opportunity to make connections here today in person. So what are some of the current trends and themes in finance? Well, these are themes maybe that have been ongoing for the last decade or so. We've seen an emergence of topics such as that of ESG, sustainability, care about our climate, our planet. What does this mean for the financial industry? We have also seen, of course, the emergence of many fintech companies, whether it's data analytics or predictions, the providing of various kinds of models, but also things like robo-advisory have now existed for a little over 10 years. And of course, what many of us talk about today are cryptocurrencies and DeFi. What do these trends and themes have in common? Well, they rely typically on these newer technologies, right? Things such as that of cloud computing, blockchain, and at the very bottom here we listed today's topic, which is how to lever AI and machine learning tools and techniques in these types of areas. So I hope that gives you a little bit of an idea of what's going on in finance, especially if you are not actively working in this area. Let me speak now a little bit to the specific machine learning challenges that many of us are encountering when we're solving financial decision problems and time series problems. So the way to think about this is we typically deal with small data problems. Okay, the data sets that we have are typically small for two different reasons. One is because some of these data sets are simply inherently small. If you're looking at most corporate events, right? Corporate events happen often on a schedule. Earnings are announced once a quarter, so 4 times a year. So that limits the number of observations you're going to have on earnings. Many other financial variables are of that kind. But now if we turn to financial markets and high-frequency trading, for example, you might say, well, there we're looking at the entire order book, and these data sets are humongous. We have the big 4 V's here, right? The big data, volume, variety, velocity, and veracity. But these data sets, we argue, are effectively small for the reasons that these data sets are typically non-stationary. They exhibit fat tail behavior. So if you're going to get things right in the fat tails, you don't have that many observations in those tails. And also these financial data sets exhibit complex non-IID type of behavior. So this is in contrast to that what we see in maybe more what we now would consider more traditional machine learning applications. So consequently, it can be very challenging to apply neural network and deep learning models that are typically very data hungry to the kinds of problems here. And we'll see a little bit of these types of applications today. And we also frequently experience a low signal-to-noise ratio. When I personally work on models that forecast markets, and I tell my colleagues outside of finance that I'm really happy with an R-squared of 1%, they look at me strange, right? If you're coming from another discipline, you might be used to R-squares of 70% and above. Forecast financial markets are, for a reason, very difficult. There are many that are doing it. It's competitive. These markets are, on average, efficient. So dealing with these problems, we often end up overfitting our models unless we're careful. And standard regularization approaches are often not enough and can introduce significant biases in unwanted ways. So in the area of finance, we often look for financially motivated ways of regularizing our problems. We'll see a little bit of that also here today. But let's turn over to this topic.
Thank you, Peter. So, are financial markets complex? In order to first ask that question, we need to be saying, what does it mean, complexity and complex? So usually we are having some kind of definition that's not fully formal, but it goes along the lines that it's a large number of interacting agents that are acting in a nonlinear way, and there is a presence of feedback loops. So the presence of feedback loops is quite important for this because it introduces an additional complexity when you're applying these things, at least for financial markets. Okay. So also what is very important that many agents here or participants, they have different objectives or utilities. They have also access to different resources, to different distinct information. So there is also an asymmetry in information content that they have. Okay. So on the right-hand side, you see some of the pictures that are trying to show some of, let's say, maybe herding behavior that are happening on social media. You can see Elon Musk raising out a small dog that represents a Dogecoin. You can see a picture of Wall Street bets and also something that represents cryptocurrencies. So all of these markets are exhibiting herding behavior, bubbles, self-excitations. And in order to study these type of systems, usually one does not only need to study machine learning tools, one also needs to study, understand, and borrow the techniques from complexity sciences. Okay, and now coming back to the developments of machine learning. So last decade, we have actually witnessed so many new breakthroughs in machine learning. We have also seen that there are kind of challenges when we are talking about direct application in finance. While being explored in academia, because of these challenges that we have mentioned before, some of these approaches are still to be find practical applications. So let's just pass through some of this, let's say, decade of developments in machine learning. I'm quite sure that you're recognizing some of these topics. We are just going to, or maybe even all, we will focus on some of them and just like briefly touch upon some of them, like long short-term memory that has a long history, CNN convolutional neural networks. Then there was quite breakthrough also with mechanism of attention that somehow is allowing machine learning models to look and have attention and context on only one part of data that is somehow going beyond what previous recurrent models like LSTMs were doing. Then we have also witnessed a lot of breakthroughs in NLP through use of transformer-based models like BERT, GP3. And we are also to have today in a panel a person who has been contributing to this area. Also like recognizing that concepts from game theory with generative adversarial networks can bring a novel way how to do training. Then deep reinforcement learning that somehow was quite important for a lot of decision-making things. We have also witnessed that big tech companies have made such an impressive also tools for certain games like AlphaGo. And most recently, we have also now seen an emergence of, let's say, of dynamics and physics that somehow being blended with machine learning tools. So now you are seeing and witnessing a lot of, let's say, mix of the tools, and we call it also physics-informed neural networks. Then there is a neural order differential networks that are somehow trying to exploit the dynamics that is described with certain set of differential equations. Of course, like geometric deep learning, then graph neural networks, etc. Okay, so classical statistical learning, just to name it, was actually, it takes its roots in the Vapnik theory of statistical learning theory. You have had this kind of descent curve. So when your complexity of model was increasing, after a certain point, you actually have seen that risk was actually going up, or here we can say that it's out of sample error, and then statistical learning theory was bounding the empirical risk with different type of theories. But what also recently emerged is that these theories were not able to fully describe what's happening with over-parameterized models like deep learning that are having millions or even billions of parameters. And this is kind of still on an active research that says that after a certain transition point that there is kind of a double descent curve where in this over-parameterized regime, because of certain inductive biases of smoothness, actually these deep learning models can actually perform well out of sample. Okay, and there is also something that we want to clarify and emphasize more. That's like physics/dynamics informed machine learning models. Why that? So as you have seen, like even a theory of deep learning is still being developed. Okay, so it's a little bit lagging behind the practical applications. But usually standard assumption here is that both training data and test data are independent, identically distributed. And usually financial models and our reality is not obeying these assumptions, okay? And this is why we are mentioning here, for example, that it's important to incorporate the knowledge of the dynamics into the machine learning models. Usually these kind of models can be enriched by assuming some kind of reality-informed priors or some kind of reality-informed models like inductive bias. If we say that we are understanding what our structure between different connections should be, then we go to something like graph neural networks, or if we are having an assumption on differential equations that are running the system, then we go to neural order differential equations or SDE solvers. Okay.
So before we start introducing our speakers here, we wanted to also address this topic of bringing theory and practice together. And I think the first statement here that's important is that the role of investment management, trading, and banking hasn't really changed. It's been in existence for hundreds of years, and I can with high certainty predict that it's going to continue to persist like this. However, technology emerges, and machine learning has allowed us to create more realistic models, models that are able to adapt to changing market conditions. It's also introduced new interesting ways in which we can do decision making and time series forecasting, for example. And the aim for this track, although we are not going to be able to cover all of these different areas, is to feature some of these recent developments for you here today. Some key points that we think are important as a practitioner in this field to consider is how to best use and lever machine learning at the firm level, right? How can different companies in this area lever the new technology? An important question that then often emerges is that of understanding the models themselves. How interpretable are these models? And perhaps in-house, the researchers and the developers of the models care less about interpretability, but typically at the client end, we want to be able to explain to the clients why certain models are making the decisions they do. It's of course important to understand the risks and the weaknesses around the models and the processes. And while this is a topic that we're not really going to cover in detail, I can tell you that this is an ongoing conversation in the financial industry as to how one should validate these types of models before they're put into production. So to give you just a very brief overview of this track, we have some talks that are going to be delving into time series approaches, forecasting high-frequency mid-priced returns using high-frequency data. These are very large, dense data sets. We're going to look at machine learning approaches for predicting stock return volatility. We'll have a talk on deep reinforcement learning levered in the context of market making. We'll also delve into some agent-based modeling, where the aim is to disentangle different sources of predictability with applications to the estimation of time-varying correlations and volatilities. We'll also have two presentations on NLP type of applications. One is a little bit more of a theoretical approach that tries to or aims at understanding the biases and the word embeddings from the Longer and MacDonald polarities. And then we'll also look at how news sentiment can explain contemporaneous and abnormal stock returns. We'll have a talk on the explainability of graph neural networks, and two talks on consumer finance, one that is looking at fraud transaction detection, and another that looks at online consumer shopping behavior. That will be all of us here. And then we'll close this track at the end of the day with a panel discussion with a mix of both academics and practitioners, so that we can hear the different perspectives and the different sides of this developing area. So we hope that you're going to have a really great time here with us today. Our program is relatively packed, back to back. We'll take questions after each session. We have a few minutes for that. But then we also have breaks. So if you have more in-depth questions, please go out and meet up with the speaker directly after their talks. But of course, you're also welcome to reach out to all of the speakers by email. So with that, we're going to set up for the first talk, who will be Fabrizio Lillo, who will be talking about modeling time-varying interactions in financial markets.